In your view, Steve, do you think the Fed is actually being aggressive enough here? We know inflation is a major problem. Are these rate hikes going to go far enough to start addressing it?
The risk actually at the moment is that they go too far, right? So I think if you're looking at what they've done, obviously 75 basis points is what we were expecting for the full year at the beginning of the year, right? So they've done that at one meeting. So at the moment, they're very focused on inflation. That's understandable given where inflation is and where inflation expectations have been. But they are at the same time downgrading their growth expectations as well. So I think that's the key challenge facing the Fed. When will they pivot from focusing on inflation to focusing on the economy? They're clearly not there at the moment and signaling they're not going to be there at least for the next month or two, and maybe even longer. But I think that's the key thing that we need to be watching out for. Either do they start moving their focus to growth too late, and therefore we go into recession, or is it just a really challenging situation that they just fail to manage?
That's right. The Fed really has to thread the needle here. A tough balancing act between not only facing cooling growth, but also the prospects of a recession as they continue on with this upward march when it comes to rates. We've just finished a conversation actually with former Fed Governor Robert Heller, who basically said that a recession is now on the way. So, Steve, how should investors be thinking about this from a risk positioning perspective? Where do you want to be exposed in an environment where we are continuing to see rates going up and concerns about global growth and growth in the United States still being front and center for markets and investors?
I think what's gone under the radar a little bit, obviously, I mean, there's been very, very few places to hide, whether you look at bond markets, equity markets, even equity sectors, only energy has done well this year. But what is starting to come through more recently is there is an outperformance coming through from Asian assets generally. So whether you're looking at Asian equity markets, the outperformance there has widened quite significantly actually over the course of the past week, obviously given the volatility that we've seen in the US. But that's also coming through when you look at local currency bond markets and also US dollar bond markets as well. So this idea that we saw the sell-off in Asia much earlier than we saw in developed markets, but specifically the US. That led to them being cheaper earlier. And I think people are now saying, if I want to desensitize myself to some degree, of course, from the Fed, it's not to say you can escape it totally, then maybe I should be looking at increasing allocation to assets in Asia. And if we were to see the dollar peak, and I think we do feel that we're getting to the point where it's really difficult to revise higher continually Fed expectations for rate hikes. So if the dollar does ultimately peak, and then that could really turn what is a trickle into Asian assets into something much more significant and lead to much more significant outperformance as well.